The average true range, ATR, is one of the most versatile and widely used indicators in technical analysis. Developed by J. Wells Wilder in his 1978 book, New Concepts in Technical Trading Systems, ATR measures market volatility and is an essential tool for traders across various markets, including stocks, forex, commodities, and cryptocurrencies. In this video, we'll dive into the concept of ATR, how it works, and how you can incorporate it into your trading strategy effectively. Wilder originally designed ATR for commodities markets, which often experience significant price fluctuations. However, its applications have since expanded to include all types of markets and instruments. To calculate the ATR, follow these steps. The first step is calculating the true range, which is the greatest of the following: the difference between the current high and low, high-low, the absolute difference between the current high and the previous close, absolute difference between the current low and the previous close. Once you have the true range values, calculate their average over a specific number of periods, typically 14. This gives you the ATR. Most trading platforms automate this calculation, so you don't have to compute it manually. Please note that period 14 means the previous 14 candles are taken into the calculation. As the candles gradually increase in size, the value of the ATR, which is normally depicted as a line, goes up. As the average candle size of the previous 14 generally decreases, the value of the ATR goes down. ATR is crucial for several reasons. Measuring volatility. ATR provides a clear picture of how volatile a market is. Higher ATR values indicate higher volatility, while lower values suggest calmer market conditions. Setting stop-loss levels. Traders use ATR to set dynamic stop-loss levels. By considering market volatility, you can avoid setting stops too tight, which might result in premature exits, or too loose, which could lead to significant losses. Identifying breakouts. ATR can help traders identify breakout opportunities. When ATR spikes, it often indicates increased activity and potential breakouts from key levels. Position sizing. By understanding market volatility through ATR, traders can adjust position sizes to manage risk effectively. Oh! Here are some practical ways to incorporate ATR into your trading. Volatility-based stop-loss. Multiply the ATR value by a factor, for example, 1.5 or 2, and set your stop-loss that distance away from your entry point. This ensures the stop-loss adapts to market conditions. Example: if ATR is 20 pips and you multiply it by 2, set your stop-loss 40 pips away. Trailing stops. Use ATR to set trailing stop-loss levels. This allows you to lock in profits while giving the trade enough room to breathe in volatile conditions. Trend confirmation. Combine ATR with trend indicators like moving averages or the average directional index, ADX, to confirm the strength of a trend. Rising ATR during a trend indicates strong momentum, while declining ATR might signal a weakening trend. Breakout trades. When ATR values spike, it may signal the beginning of a new trend or breakout. Use ATR alongside support and resistance levels to identify potential trade entries. While ATR is a powerful tool, it's not without limitations. It is a lagging indicator. ATR is based on past data and may not react quickly to sudden market changes. Subjectivity. The choice of period length, for example 14 days, can affect ATR values, leading to different interpretations. No directional bias. ATR doesn't indicate price direction, so it's best used alongside other technical indicators. If you are creating an expert advisor, using the ATR indicator as an exit strategy could increase its success rate tremendously. This is because the ATR would know when to have to small or large stop loss, hence it prevents the trades from closing too early, nor does it allow the trades to stay open too long for the market to reverse. Albeit that, because of its practical use, the ATR doesn't necessarily complement many trading indicators. However, it is a powerful tool to have in your trading strategy to determine exit levels. The average true range is an essential tool for traders aiming to understand and manage market volatility. By incorporating ATR into your trading strategy, you can make more informed decisions, manage risk effectively, and improve your overall performance. Whether you're a beginner or an experienced trader, mastering ATR can provide you with a significant edge in the market. For more in-depth trading insights and tutorials, don't forget to subscribe to our channel and hit the notification bell to stay updated on our latest content.